Hello there, welcome back to Chain Accounting. In this video, we want to look at a question, this question paper, which is on question 1.2. And this is an analysis of transactions. This is a question paper of November 2023. So we're going to go through the questions and answer what is required. The question is analyze the following transactions according to the headings provided in the answer book. The business uses a markup of 50% of cost. Very important to take note. So remember, we are going to say our markup is 50%. We have our cost price is always 100%. So our cost price plus our markup obviously will give us our selling price. So what we are saying is our cost price is always our 100%. And we add our markup that we are given here is 50%. Depending on the question, in this question, we put 50%. When you add the two, you're going to get 150%. So this is what we have in terms of our markup. Then the question continues, assume that the bank balance is favorable for all transactions. We are given an example, bought stationery for cash 2,000 rands. Then on the answer sheet, that you are given in the answer book, we can go back there and see what we have on the answer section. So this is the other section that we have. So remember, we are looking at 1.2. So this is 1.2 that we have. So we're given an example there of this stationery. If you try to go back to see the double entry that is there in terms of this example, is saying bought stationery for cash 2,000. So it means we are going to credit our cash and debit our stationery. So this is the double entry that's involved in this example. So we are seeing that we are debiting our stationery here and then crediting our bank, and then obviously you show the effect on the accounting equation. The amount obviously is 2,000. But remember, when we debit our stationery, this is an asset, so it means we are having an asset here, and then also we also have our accounting credited being an asset again. So we are seeing that it's a debit and a positive. So here by crediting bank, we are subtracting an asset. So it means you are supposed to show a negative on the assets. You're going to show a negative on the assets. In other words, what we are trying to say is we are going to show a negative on the assets here, and then we are going to show a positive on the asset again by crediting. It's a negative because bank we are crediting. When you credit an asset, we are supposed to subtract. So this is shown by the subtraction sign. And then when you debit now the stationery, remember, in the form of stock, it becomes an asset again. So it means when you are debiting now an asset, is supposed to be a positive. So you put a negative and a positive here, which means here on owner's equity, we don't have any effect that we are going to notice there. So we're just going to put a 0. So this is supposed to be the example that we have. So if you go back there, you see that let's try to see on the first part, which is 1.2.1. Let's try to check on 1.2.1. So on 1.2.1, it reads bought equipment on credit for 10,000 rands from 20 finishers. So what we are having there is that we are buying equipment. So obviously we are debiting equipment. That's the double entry that we have there. Debit your equipment, and then you credit the squad finishers because it's on credit. Remember, when it's on credit, we open the name of the business or person that we that we are buying from. So we are going to credit our creditors control, and then we debit our equipment, which is an asset. So whenever we debit our assets, we are supposed to show it as a positive. So basically, what we are saying is on our double entry, we have to take note that whenever we are debiting our asset account, be it a non-current or a current asset account, when you debit it, we are supposed to show it as a positive. When we credit an asset account, we subtract. So the opposite is true when we are now on liabilities. So on liabilities, what we are going to do is that whenever we credit, that's why we are going to show it as a positive. When we debit, show it as a negative. So this is what we have. So this is just what we are going to employ there as we are going through the question. So we can just go back there and try to see what we have there. So we are saying on the first one, which is 1.2.1, what we are doing is we are going to debit our equipment, which is an asset. So we'll debit to say positive, and then we create our creditors control. Creditors control is our liability. So we are also supposed to add. So when we credit a liability. So we come here. So basically what we are saying is we are going to say debit equipment, and then we credit creditors control. So here we are supposed to have our creditors, our creditors control. And then the amount that we have there, we can maybe try to check what amount we have. We've got 10,000 rands, so we've got an amount of 10,000. So we come back here, we are saying amount that we are having is 10,000. And we are saying we are debiting equipment, which is an asset. Whenever we debit an asset, we are supposed to show it as a positive. And then we are crediting creditors control, which is a liability. When we credit a liability, we are supposed also to show it as a credit. So this is what we have. So we go to the next one, which is 1.2.2. So we try to see what we have in terms of 1.2.2. The data in Motus paid 4,750 rands via EFT in settlement of their account of 5,000 rands. So this is a data we're paying an amount, so it means obviously we are going to debit our bank. We are going to debit our bank since we are receiving through an EFT, which is through bank. So we debit our bank, and then obviously we credit the debtors account. So a debtors account, remember, is an asset also. So it means when we are going to credit the debtors account, we are going to show it as a negative. Remember, we said when the crediting an asset, we show it as a negative. So basically, the scenario that we have is like this. This is N Motos account. So this 5,000 that we have there is on the debit side. So upon payment now, when this data is paying, we are supposed to put it on the credit side here, 4,750, and then this is obviously a negative because we are crediting an asset here. And then obviously there's a difference that is there. We are going to notice that there's a difference of 250, which we are supposed to credit also, so that we clear this amount 250. And this 250 obviously is going to be the discount allowed. And then it means on this double entry of 4,750, we are crediting the debtors control, and then we are going to debit the bank, since this is a payment through EFT. We're going to debit the bank on this one, and then on this 250 we are crediting the debtors control, and then debiting the discount allowed account. So these are the two double entries that we have there. So we go there and just summarize that. So we are given this as our unit that we are crediting debtors control with 4,750. Remember, 4,750, and then we debit bank. And then we debit the bank since we are receiving through EFT. So we are saying bank. If we are receiving through cash, we are supposed to debit our cash account. Then I remember on the effect on the accounting equation, yes, we debit our bank, and this is an asset. We debit an asset, and we are supposed to show it as a positive. We're supposed to show it as a positive. Remember, we are also crediting a debtors control, which is an asset again. A debtors control is an asset, but we are crediting it in this case. So it's a minus. So we've got a positive and a minus both assets. Then the second double entry, remember, we've got discount allowed, whereby we are also crediting the debtors control again. So here we have got debtors control. We're crediting debtors control. Debtors control. And then we are debiting the bank again. Sorry, we are debiting discount allowed now as an expense. Sorry, here we are debiting discount allowed. So this is what we have on this double end. And then we check what the effect now on the accounting equation by debiting discount allowed. Remember, discount allowed is an expense. We're going to charge it in the income statement under less expenses. So it's going to reduce the amount of profit that we have. So you'd see that as it reduces the amount of profit, the profit figure, remember, it affects the calculation of the closing balance of the capital. Remember, when you are calculating the closing capital figure, we say, let's try to put it down. We say for the closing capital figure, we say opening capital, we add our net profit, and we subtract our drawings. So This is the formula that we use. So the net profit is here is going to increase the value that we're going to have for the closing capital. So we are going to see that as we so the closing capital is the owner's equity that we are talking about. So this is the owner's equity balance that we are talking about, owner's equity. And this is the opening owner's equity figure. And this is the closing owner's equity figure. So this is what we have. So when this net profit is going to increase the value that we are going to have for owner's equity. So on discount allowed, it's going to reduce this amount of net profit because it's going to be under less expenses. So in that case, it means it's going to be a minus on owner's equity. So this is exactly how we are going to represent it there. So if you come here, you see that effect that we are having there by debiting discount allowed, it means we are going to increase our expenses and then it's going to reduce our owner's equity. So come here, see that this debiting of discount allowed is going to be indicated as a negative owner's equity. And as we credit the debtors account, remember it's a minus on the part of assets. So here we are also going to have a minus. We are debiting debtors control as an asset. So whenever we debit an asset, we are supposed to show it as a negative. So we can just go there to see what we have in terms of next item, which is 1.2.3. It's saying sold goods for cash and the cost price was 3,000 rand. So you see that we've got two double entries that we step. So firstly, we have to calculate we also have to calculate the selling price. Remember, we put a markup that we are given there is 50%. If you're having a markup here, which is on 50%. So we are going to just do as such as that we get the selling price. So remember, when we are selling goods, we sell them at selling price, not at cost price. So what we are going to do is we are going to make a proportional change in terms of our 3,000 so that we get our selling price. So basically 3,000, if you multiply 3,000 by 1.5, remember our markup, our cost price is 100%. When you add 50%, it gives you the selling price, which is 150%. So here we are given our selling price is what? Is at 3,000, which is so we are given our cost price is 3,000. So the figure that we want is this one, which is the selling price 150%. So we can just make a proportion there by saying what we don't have there, what we don't have is 150, is the figure that we are looking for, over 100 that we are given, then you multiply by 3,000 over 1. And then the answer that you are supposed to get there, you're supposed to get 4,500 as the selling price. So this is our selling price. Or you can simply say 100 plus 150 as a decimal becomes 1.5. So you say 1.5 times 3,000. So basically what you are saying is alternatively, for the calculation of the selling price, you can just say your 3,000, and then you multiply by 150 as a decimal, 150% is 1.5 as a decimal, and then you get your 4,500 again. So you see that these figures are just the same. So we have got our selling price is 4,500. So the double entry that we are going to have on our selling price is that these are sales. So we are going to credit our sales and then we debit our bank. Remember, when you sell, we receive money. So we are going to debit our bank and then credit our sales account 4,500. So we can just go and enter that one. So it means on our bank, we are going to debit is already debited here. So the one that we're going to credit is now our sales. So here we are saying sales. And the figure that we have is 4,500. 4,500. So let's try to see. So here we're saying 4,500. And then by debiting bank, remember it's an asset, so we debit the bank, debit an asset with a plus, so we put a plus on assets. And sales is going to affect our owner's equity. Remember, sales are in the income statement, it increases the value of our net profit. So owner's equity obviously is going to be a plus. So we put a plus here. And then on the cost of sales, I remember this goods at a cost of 3,000. It means the cost has already been entered as 3,000, and then we debit our cost of sales. And there, and remember, these are goods that were in our stock now going out of business. So it means they were on the debit side of the stock account. Now we are crediting to remove them in our books. So we're going to credit the let's try to see the stock account. Obviously, we are going to credit it. That is the trading stock account. So we are saying trading stock. So the effect on the accounting equation now, cost of sales obviously is going to reduce the amount of the net profit. Remember, cost of sales reduces, and we say sales minus cost of sales, then we get our gross profit. So cost of sales obviously is now going to reduce our net profits. In other words, we say sales minus cost of sales, and then we get our gross profit. And then this gross profit is going to lead to our net profit. So it means as our cost of sales are being debited, it means they are increasing. So we are increasing the value. That means it's going to reduce the gross profit, which is also going to reduce the net profit. So we are going to have a minus on owner's equity, as net profit also is going to be added to our owner's equity. So when it's being reduced by this cost of sales, it means our owner's equity also is going to be reduced, the minus. Then our trading stock, we are crediting. Remember, trading stock is an asset, so when we credit it, it's a minus again. So we put a minus again on assets. So this is what we have. So we can just try to see on the next question, which is 1.2, 1.2.4. So on 1.2.4, let's try to see what we have on 1.2.4. Right, 1.2.4 reads, we are now here. The owner took trading stock at the cost of 850 rands for personal use. So remember, these are drawings. Whenever goods are taken for personal use, they are drawings. So our drawings, obviously, we debit it. And our trading stock, remember, this 850 was on the debit side of the trading stock. When it's being taken, it means we are going to opposite crediting our trading stock, and then we debit our drawings. So this is the double entry that we have, and the amount is 850. So we come here. We are saying trading stock is credited, and then we are crediting we are debiting our drawings. So it's such, we just say debit our drawings. So we are saying drawings, and then on the accounting equation, remember we have got assets here. So what we are saying is by debiting drawings, remember on the calculation of our closing capital figure, which is our owner's equity. Remember, we put down the formula here whereby we are saying get our own closing owner's equity balance. We say opening for owner's equity plus our net profit less our drawings. So it means the drawings reduces the amount of our owner's equity. So here we are having drawings, so it means going to be a minus on our owner's equity. So we come here. We are saying our drawings are going to represent a negative on our owner's equity. Seeing that owner's equity is being represented by the last, by the column at the middle. So it's a minus on owner's equity. So we're saying a minus here. And then on assets, trading stock is an asset we are crediting, and when we credit an asset, it's a minus again. So it's a minus again. Then we go to the last one, which is now our 1.2.5. The owner of the business retained damaged goods supplier. They were discounted by 5%. The original cost price was 1,800. So this was the original cost price. So discounted by 5%, it means 100% minus 5%. Obviously, we are left with 95%. So it means 95% of the total is the amount that that was the value of those goods after discount. So basically, what we are going to do now, we are going to say 95%, 95% of the total value of the goods, which is 1,800. So basically, what we are saying, let's try to see. We are now saying 95%, whereby we are saying 95% is 95 of 100 times our 1,800. So we calculate it as such, you're going to get 1,710. So this is the figure that we have, 1,710. So you'd see that this was the amount after discount, and you'd see that the discount was already reduced. So we are only going to take our 1,710. So if you come here, you'd see that these are trades. We are going to credit our trading stock. The trading stock has already been credited, and obviously, this is going to reduce our creditors, our creditors figure. Also, we debit our creditors control. So here we have got our creditors control. So the issue is these creditors the moment that we bought the goods from our suppliers, we credited the suppliers account here with the amount which is 1,710, and then now they've been returned, which means we're supposed to come to the opposite side, that is debit side of the creditors control. Now we are saying we're debiting with 1,710. So we are debiting 1,710, and then we are crediting trading stock account. So basically, this is what we have. So by debiting creditors control is a liability. So when you're debiting it, it's a minus. So it's a minus on liabilities, which is this side, a subtraction. And then trading stock is an asset we are crediting. So it's a minus again on the issue on the part of assets. Those assets, when you credit them, it's also a minus. So we put a minus again. So this is what we have, guys, according to this question. But also, what we have to take note is that we have got an accounting equation whereby we've got two sides, whereby say our assets are equal to our owner's equity plus our liabilities. So what it means, we have got two sides that we have here that are being demarcated here. We've got assets and then we've got side of owner's equity plus liabilities. So if we would see that if there is a plus on assets, it's either we're going to have a plus on owner's equity or a plus on liabilities. You understand? So this is what we have. So if it's affecting assets and liabilities, it means if there's a plus here, it's going to be a plus here. If it's affecting assets and liabilities again, if it means there's a minus here, it's going to be a minus here. So this is what we have. The same applies to now when we are dealing with assets against owner's equity. If you have got assets here on this side, if it's a plus here, it means on owner's equity also is going to be a plus. If it's a minus on assets, it's going to be a minus on owner's equity. If you just identify that the transaction is affecting assets and owner's equity, it means the signs should be the same because they are on different sides. You understand? If it's a if it's against our assets and our liabilities, it also means we are going to have a plus on assets. It's going to be also a plus uh, it's also going to be a plus on liabilities, like what we indicated there. So this is what we have. And then when it's affecting one side, let's say it's affecting assets only, if the transaction is good, is affecting the two accounts are both on assets, it means if it's a plus on assets again, and we are now entering in an asset account again, it shouldn't be opposite sides now. If it's the two accounts are on one side, it should be plus and minus. And if you are now on the other side again, if it's affecting this side, let's say the transaction is affecting owner's equity and liabilities, if you are having a plus on owner's equity, it means we are supposed to have a negative on liabilities. You understand? So if this is what we have, so what the opposite is true again when we are saying the transaction is affecting liabilities and owner's equity, and we see that there's a negative on owner's equity, liabilities should be a positive. So if the transaction is two accounts that are on the one side of the equation, this is the first side. So this is representing the first side, and this is representing the second side. So this side is got only assets, and this side is got owner's equity and liability. So let's take note of that. Very simple to master them. So this is what we have, guys, upon this video. Let's meet again in the next video. As for this video, I'm signing out.